What's up and welcome to Smart Money. In today's video, I'm going to tell you about what growth stocks are and why you should buy them. Let's jump right into it. In the first video of my Investing in Stocks 101 series, I talked about index funds. While index funds are perhaps the safest and easiest way to grow your wealth in the stock market, many of you balked at this idea. If I understand you correctly, those who dislike this idea disliked it because while investing in index funds is less risky than buying shares of individual companies, it also has a lower return on investments on average than what you hear about on TV. I do understand the thrill of buying shares of individual companies and hoping for the best, but if you're merely hoping for a strong return without having any reasons why you expect the company to produce higher than average returns, then you're speculating. Speculating, there goes that word again. Well, what is speculating? The dictionary says that speculation is the forming of a theory or conjecture without firm evidence. The second definition is investment in stocks, property, or other ventures in hopes of gain, but with the risk of loss. If I'm reading you guys correctly, you don't want to speculate. What you want is to figure out a method to purchase shares of strong companies with high future earnings at a low price. If that's the case, then what you're interested in are growth stocks. A growth stock is a company that is expected to grow at a rate that outpaces the market. You're looking to find the next Amazon, Tesla, or AutoZone while still priced at a level that most people can afford. Most growth stocks usually have these 5 characteristics. They are considered risky. They don't often pay dividends. Their prices change more drastically than the rest of the market. They have a strong earnings growth record. They have a higher price to earnings ratio than most of the market. If you research a company, find that it has these characteristics and you're still willing to invest in them, you're ready to buy growth stocks. If you haven't done your research and you still want to buy a company that you think fits this profile, you're still speculating. When investors buy growth stocks, they do so anticipating that they will be able to earn many times their investment when they sell in the future through capital gains. Capital gain is a term used to describe the rise in value of an investment. Growth stock companies tend to be very innovative. They may offer products that put them ahead of the industry or hold patents to very unique products and technologies. Growth companies usually don't offer dividends. One reason for this is because they reinvest their profits into the company in order to maintain or build their competitive advantage. Growth companies often have a devoted customer base. A company may become a growth company if they innovate a new service or product and figure out a way to corner a market. For example, Amazon may be one of the best examples of a growth company. E-commerce existed for a decade before Amazon came onto the scene in 1994. But Amazon really made itself stand out when it lowered its free shipping threshold from $100 to $25 in 2002. The company was able to corner the e-commerce market when it introduced Amazon Prime in 2005, allowing people to pay a yearly fee for 2-day shipping. Investors who are drawn to growth companies invest in them because they believe the company will keep growing in the future. This may mean that the price of a share of a growth company stock may look expensive today, but investors expect it to look cheap when compared to the price of the company in 5 years. What makes a growth company risky is that eventually the high rate of growth slows down, stops, or even loses value. A growth company's stock may plummet if investors perceive that the company might not meet its performance expectations. Some of the best growth companies are likely names that you already know. I've already singled out Amazon as one of them. While the market is expected to grow 10% per year, Amazon is expected to grow nearly 30% per year for the next 5 years. Amazon is the most readily available example of a growth stock, but it's far from the only one. Another strong example is Facebook. Facebook shares sold for $38 each when the company came onto the market in 2012. Today, the shares are worth $235 per share. That reflects an average of 77.25% growth per year over the past 8 years. Another strong and established growth stock is Microsoft. In June 2015, Microsoft stock sold for approximately $46 per share. Fast forward to June 2020, and the stock is up to $194 per share. That reflects over 400% growth in 5 years, or an average of 84% growth per year. And the best part about that is Microsoft pays a 1% dividend, breaking the pattern with the other growth companies. A growth stock is a company that is expected to grow at a faster rate than the rest of the market. Growth stocks are often seen as risky because the growth might not continue as expected. Investors make money on growth stocks when they sell the stock for capital gain. A few examples of established growth stocks are Amazon, Facebook, and Microsoft. Well, that's my video explaining growth stocks. I appreciate you watching. Let me know any questions, comments, or topic suggestions you might have on personal finance in the comments below. Be sure to support us on all of our social media platforms. Follow us on YouTube and now on Facebook at Smart Money. Links will be in the description. If you're watching on YouTube, subscribe and hit the notification bell to be the first to know when I come out with new content. Thanks again for all the support in the comments section, and a special thanks to KMAC Holdings, who was our featured comment for this week. Make sure you join the discussion for a chance to have your comment featured. I read and reply to all the comments I get. Make sure you like the video for the algorithm and be sure to share the video with a friend. Check the links in the description for offer information. Lastly, the stock market is set up perfectly to buy stocks at a discount right now. Even if you're just curious and looking to start with $100 or even less, I'd recommend using Robinhood. It's completely free. Plus, if you use my link in the description, you get a free stock just for opening up an account. It's a win-win. Comment below and let me know what you get. Thanks for watching, and I'll see you in the next video.